Hey, good morning, everybody. Welcome into this week's long-form episode here on Mining Stock Daily, and it is indeed a long one with two segments for you this weekend. It was getting to you this last Friday, last day of trading this Friday and through the weekend. Our first segment, we're going to feature Cross-Border Capital's Michael Howell talking about where all this liquidity is coming from and what he expects to see through to Q2 and into the second half of 2024. Good conversation with Mike. Big picture type of conversation, as always, with him. And then we talk about the relationship between the U.S. government and the mining industry with a seasoned veteran based out of D.C. with a career with Rio Tinto and also Talon Metals now. His name is Todd Malan, and it's just a great conversation about how that relationship continues to evolve right now within previous administrations, the Biden administration, and potentially the next administration. So wonderful conversation as well. Special thank you to Fireweed Metals, Victoria Gold, Visa Silver, and Arizona Sonoran Copper for their continued support of the podcast. And if I could ask you, the listener, please leave a review, a like, subscribe, share, all those things to help us get in front of new people interested in the mining and exploration sector. All right, everybody, let's step into my conversation with Michael Howell. Have a wonderful weekend. Be safe and be well. Well, it's been a few months. The last time we got to talk to Michael Howell was back in person in November in Frankfurt during the Deutsche Gold Mess. And he had some profound things to say back then 5 months ago regarding liquidity and where it was going to come from. And, I think my jaw dropped to the floor a couple times in that conversation. So it's probably time we pick that conversation back up with Mike from Cross-Border Capital. He is the godfather of liquidity, in my opinion. Mike, it's a real pleasure to have you back on.
Thanks, Trevor. Great pleasure to be here.
Yeah. Listen, we've kind of got this, what appears to be almost everything rally. We've got a rally in tech stocks and the S&P, even assets, alternative assets such as Bitcoin and also gold are making new all-time highs. And so I guess the first question, the big blanket question for you, Mike, is exactly where is all this liquidity coming from? Because we have not seen much of a move in interest rate. We've seen speculation in the bond yields, but not an official move from the Federal Reserve. So let's throw it out there. Where's the liquidity coming from, Mike?
Okay, well, I think the first upfront point to make is that money moves markets. It's really as simple as that. And watching interest rates doesn't really matter very much in my book. You just got to understand the flows and the direction of flows and where that money is coming from. And that's pretty much the $64,000 question. And broadly, it's coming from central banks. The Federal Reserve has been injecting liquidity pretty much since the SVB crisis back in March of 23. You could actually even make a case that the Fed began to twitch immediately after the British gilt crisis that prior September. That debacle was a wake-up call to policymakers everywhere as to how fragile perhaps global fixed income markets were. And at the end of the day, despite the sort of rhetoric about how they're trying to beat inflation, I mean, clearly that is a priority. But the underlying sort of modus operandi of all these policymakers is to preserve the integrity of the sovereign bond markets. That's really their major goal. So at the end of the day, when there's anything which spooks these markets, whether it be a British gilt crisis or an SVB debacle, then what you're likely to see is central banks actually moving and injecting liquidity into the system. What we've seen pretty consistently since that point, since March of 23, is liquidity moving into the system, despite the backdrop where policymakers, particularly the Fed, continually tell us that they're shrinking the balance sheet, and that's designed to tighten liquidity. I mean, plainly, it's not working if that's their idea. You just got to look at what markets are doing. You've got to look at metrics like the Goldman Sachs Financial Conditions Index. All these things tell you that liquidity is pretty abundant. We think that Bitcoin, for example, is a monetary inflation hedge par excellence. It's a great barometer of liquidity conditions, and it tends to move very early in the system. Gold tends to follow. Gold, we know, has got a much, much longer and more robust track record as a monetary inflation hedge, as a barometer of expanding liquidity. And gold is starting to move now. It's almost exactly on track. this is very, very much a normal investment cycle, despite what economists keep telling us. It's moving as one would expect. And the reality is that central banks are behind this.
A normal investment cycle. So can you clarify for me, specifically me and everybody else listening, where we're at in the cycle? I mean, what exactly does this period of the cycle mean?
Well, I mean, we tend to look at a cycle as being something like maybe a 5 to 6 year swing in liquidity. That's the extent of the cycle. It has
Mm,
4 phases. We tend to think of those phases, which we label generically as rebound, calm, speculation, turbulence. We've been for a long time, pretty much since as I said, the British gilt crisis, in a rebound phase. We're probably pretty near moving into what we would call a calm phase. Markets in many ways are ahead, particularly if you look at Wall Street. We think Wall Street's slightly ahead of that liquidity cycle, but it's moving more or less in fashion with that. How
mm,
long will the cycle last? We think the cycle is going to last until probably late 2025. The sort of caveat against that, or to throw into to make this a little bit more interesting, is that if you look at Wall Street's normal reactions, something like what 2/3 of the ultimate gains in Wall Street come in the first 15, 16 months of a rally. And we're pretty much at that point now. So the gains that you're going to see are going to be harder to come by. They're going to be more erratic, more prosaic in many ways. And you've got to start thinking much more about rotation and maybe looking for ultimately, some sort of midterm correction in markets. I mean, I think that we think is
mm,
likely to occur in the next quarter. And the reason we say that is that, if you track liquidity flow, particularly coming out of the Fed, there is a big challenge up there. And that challenge is what happens around April as we move into Q2 with the tax season. And what you've got, without getting deliberately or too wonkish in this, something called the Treasury General Account is an account that's held at the Fed, which basically holds the deposits of the US Treasury, the net cash inflows. The Treasury normally gets a huge inflow around April time as tax payments start to wing their way into that account. That is a direct withdrawal out of money markets, and the tempo of the US economy of late, plus the fact that Wall Street's been so buoyant in the last 12 months, pretty much nails the fact you're going to getting out a lot of tax revenues coming in. So the TGA is going to be bloated. That is an extraction of liquidity from markets. At the same time, coupon issuance is stepping up, is slated to step up. In other words,
mm.
they're shifting away from bills towards more coupons in terms of funding the deficit. And that by itself is going to be a technical withdrawal of liquidity from markets, mainly because their previous option of using bills was a ready way of getting another account, the reverse repo facility, down very heavily at the Fed. The reverse repo facility has fallen dramatically, something like 1.9 trillion from its peak, and that has been a pure liquidity injection in markets. And that has coincided with the shift of the Treasury away from traditional coupon issuance towards bill issuance. And the Treasury have deliberately marketed a lot of these bill issuance to money market funds by giving them the sort of specific tenors they want.
Hmm. Fascinating. I want to go back and talk about. It's been 1 year since the debacle with Silicon Valley Bank, and then the kind of the fallout from that news. And here we are, not too far off. It sounds like New York Community Bank is being saved from the cover by the private sector. But I'm just kind of curious. We are in an election year, and you had mentioned in a previous conversation with another channel regarding you don't think the administration wants to see any more fallout in regional banks for any speculation of a lack of trust in the system with where we're at with these higher interest rates. So I'm not one to think that Steve Mnuchin and company just went in there on their own and made the deal. I do think there was a handheld through the whole process. Just my own speculation, but I think it's
I'm sure
safe to
that's
say.
absolutely correct. I think
Yeah,
the Fed are on top of this. I'm
yeah,
sure
I think so too.
Uh, they
Right.
they they clearly don't want a debacle or any upset in an election year, particularly for the regional banking sector. And if you look at the distribution of reserves, this is the key point, that it may well be that on average reserves look pretty healthy for the U.S. banking system overall. They're currently it's something like 3.6 trillion. And bear in mind that's a significant climb from where we were at 6 months ago. So bank reserves continue to go up. The problem is that it's the big banks, the big money center banks, that are basically taking all those reserves. So if you look at regional banks, smaller banks, from data that the Federal Reserve itself publishes, they're still got very, very low levels of reserves. And they're at levels that are probably not dissimilar from where we saw the March 23 banking crisis that hit SVB. So these regional banks are clearly not out of the woods. There are problems there. The big money center banks are actually, sucking up most of this liquidity. So JPM, for example, is probably on a roll right now because it's such a strong position. The smaller banks are not, and it's the smaller banks that will matter, particularly for political reasons, as I outlined.
Yeah. Well, we're also kind of concluding that bank term funding program, which was put in place after SVB. That's coming to a close here. And maybe share with me your thoughts on implications of that program, coming to end. It's quite interesting timing, given the recent news out of New York Community Bank, then also during an election year.
Well, I think it's really a moot point. We're groping in the dark to try and understand what the implications of this will be. The bank term funding program, has now ended, and basically what it means is that up to the deadline, banks could borrow for a year against collateral from the Fed. Now, those that probably needed it have done it, so those balances will still persist for 12 months. I think the problem comes, or the issue comes, is what happens if there's more stress on the system and they need to come back to the Fed. Now, the Federal Reserve basically believes they've got facilities or programs in place that can essentially aid any problems in these banks. So, for example, they're trying to encourage banks to go to the discount window. Now, not only is there a stigma attached to going to the discount window, in many cases, from what we understand, and this is anecdotal, observations, is that a lot of the regional banks actually don't know how to go to the discount window, and that was a problem I think that was echoed by SVB. It's a route that hasn't been used, so maybe on paper it exists, but when push comes to shove, it may be a more difficult question. So I think it's more prudent for the Federal Reserve to basically keep the level of reserves rising, because at least under that remit, what you're likely to see is regional banks, not or having some access to liquidity in the system. But it's a moot point, and ultimately we don't know. Is there a risk of a policy error in the next 3 months? Yes, absolutely. That's what we've been saying. We don't know quite how this is going to operate. If there are tensions, has the Fed got the right tools there to actually to solve that? They have after the event, but you may get some distress in the system. And I think with the backdrop, as you said, of New York Community Bank wobbling, and maybe that being an indication of stress generally among regional banks, then I think we've got to be alert to this problem. And unfortunately, Governor Waller has said that he's quite prepared, or the FOMC is quite prepared to let bank reserves dip below 3 trillion again. Now, starting from 3.6, that's quite a serious reversal. And if that happens, watch out. Markets will come back with a thud if that's true. I don't think the Fed wants that. I think they want a strong economy. I think they want a robust financial system, and to play around with levels of bank reserves, fine tune them is, I think, asking for trouble.
Yeah, no. I do want to ask you about kind of this move recently in the markets, as far as the liquidity versus a rate cut expectations. These two seem to be playing hand in hand here. Uh, you know, at the beginning of the year, the Federal Reserve was talking 3 cuts to their Fed funds rate. That would typically take it from 5.25 to 4.5. I find that to be a little bit of a muted point, not terribly dynamic by any means. But the market had 6 cuts priced in. Well, obviously the market was way ahead of its skis there at the beginning of the year, and has since pulled that back and kind of come to terms. But there's still this expectation that we are going to be in a cutting cycle. Now
Correct.
we're pairing that with this continued move with liquidity, global liquidity. right now. We're seeing that play out. I mean, I guess I don't know if there's a great question or not, but how are you? Can you have one without the other? I guess is what you can say. Can you have that expectation of the market with a rate cut cycle ahead of itself without the liquidity boom?
Absolutely, you can. I mean, that was, that surely should have been the one takeaway that everybody learned from the days of Milton Friedman. Milton Friedman always used to say, interest rates are the worst possible measure of monetary ease or tightness. He's been, I think, well and truly proved right over the decades. That's true. From my days at Salomon Brothers, it was always about looking at flows of funds. I mean, that's the critical thing to do. Unfortunately, economics has an obsession with interest rates, which is the wrong thing to look at. Interest rates are always, I think, a misleading indicator. And there is the market just pause over what the Fed, what the dot plot's doing, what Fed funds rates are going to do, and ignoring what really matters, which is flows of liquidity. And as I've been trying to say, and hopefully got it correct, since the SVB crisis, the big increase in liquidity is what's moving the market. It's nothing about interest rates or interest rate expectations. It's all about liquidity. Through that time, interest rates expectations have flip-flopped both ways, but the market's still gone up. And that's the point to remember. The fact is that what the Fed should be doing is focusing a lot more on the supply of liquidity for the stability of the system, and it should be keeping interest rates at high levels. The fact is that economics has sort of led us down the wrong path for a long time. And it almost goes back to sort of days of Keynesian economics, where Keynes had this equal obsession of about the euthanasia of the rentier, where he said, if you keep interest rates low or zero, you'll get rid of this sort of unproductive class of people who just live off interest. Now, that obsession of low interest rates has been with us. The problem is that if you keep interest rates low, people just borrow debt. The debt pile is absolutely balloons. And this is the problem the world economy's got now, and why the whole financial system is fragile. Because as we keep emphasizing, which seems to be lost on many people, the fact is that if you've got 350 trillion of debt worldwide with an average maturity of 5 years, which is what it is, you're going to have to refinance 70 trillion of debt every single year. These are eye-wateringly large amounts of money. And you need liquidity and balance sheet capacity in the financial system to do that. If you don't have that capacity, you get refinancing crises. And hey, what have we seen for the last couple of decades or so? A whole range of refinancing crises. It's all about liquidity flow, and that's really what matters. When there's a lot of liquidity in the system, more than sufficient, that money is fungible. It'll go off into asset markets. And that's exactly what's going on right now.
Last time we talked in November, you had talked about the Federal Reserve being the main purchaser of U.S. debt. In fact, you kind of had this incredible graph that I think you had at least $5 trillion spread out until 2050. I don't have the graph in front of me, so you can correct me, where I'm wrong here. But are we starting to see this play out? Because you talked about the issuance of coupons here. Over the last 5 or 6 months here, Michael, there have been a number of supply coming online. How do you kind of summarize up who's been acquiring that debt, and where have we started to see the central banks coming in and being that purchaser of last resorts? And have we seen that expand yet?
Well, I think let's try and frame this, Trevor, because I think the issue is we've got to look at the cycle and we've got to look at the trend. Okay. And the cycle may well be going up, and that's what we argue. But behind that, there's a very strong trend, and the trend in many cases is a lot more important than the cycle. And that trend is dominated by the breakdown, if you like, or deterioration in the fiscal arithmetic across the West. Now, this is a point that I and others have basically made or tried to hammer home. And what we're in is a very changed world here. Basically, the debt to GDP ratio, or more specifically, the public debt to GDP ratio in the West is skyrocketing. It's skyrocketing in the US as well. I'm not hitting on the US because the US happens to be the cleanest shirt in the laundry in many cases. But the fact is that the US is actually very transparent and very honest in many cases with its data provision. And so the Congressional Budget Office put forecasts out until 2050 of what the debt GDP ratio should be or is likely to be in the US. their numbers are scary in the sense that the debt GDP ratio goes from slightly above 100% now to about well over 200% by 2050, so more than doubling. But actually, their numbers are probably conservative for a whole number of reasons, not least because they don't factor in any potential recession in the next, if you like, in the next 30 years, which clearly there must be by definition or by probability. So what you've got is a huge escalation in debt. And the fact is that's coming for, broadly speaking, two reasons. One is that mandatory spending is starting to push up the Medicare, the Social Security bills, in the US, but more generally, and particularly in other countries where there are more generous social provision or welfare provision. What you've also got on top of that is defense spending, which, I thought almost anyone would tell you has got to be higher than it is now, given the geopolitical tensions. And the question is, if you've got these rising deficits, and in the case of the US, what you're looking at, and this is, we're in a big deficit period now with Biden's spending programs. But this is going to be nothing new. The fiscal deficit in America runs on at something like 8 to 9% of GDP every year for the next decade, according to the Congressional Budget Office. These are big numbers to fund. Let's make no mistake in that. How are they funded? Well, they either come domestically or they come internationally. What is the appetite of foreign investors for US debt? Well, you can put a big question mark over China, which has been a major buyer in the last 10 years. Japan may keep going, but Japan's got its own deficits to fund. So you're being compromised. And then you've got a reliance on OPEC. And OPEC, we know, the OPEC nations are likely to be turning elsewhere because they don't want to put all their eggs in maybe the US or the Western basket. So at the end of the day, foreign demand is going to be challenged. And then you've got domestic demand. And who's going to start buying domestic government debt when you've got other funding demands to be made? So it's got to be somehow either the Federal Reserve, which comes back, and that's the view, I would say, implicitly of the Congressional Budget Office, which is a bipartisan organization, as you know, or it's got to be the banks. And what you're starting to hear now coming out, sort of reading between the lines, is that there is going to be a direct encouragement or even maybe a regulation change, which will allow the banks to hold a lot more treasury debt, which is actually what they used to do. And if you go back, maybe ironically in a sense, during periods of wartime, the banks used to hold an awful lot of government debt. And maybe if we are in a pre-war situation, heaven help us, but if we are, you're going to get back to a situation where the banks are owning debt. Now, whether it be the Federal Reserve or whether it be JPM or whatever who owns the debt, this is monetization. Make no mistake, okay? It's monetization. Monetization means monetary inflation by definition. And monetary inflation ultimately spills over into the high street. The best hedge for monetary inflation over the long term has been the price of gold, been gold bullion. The gold price moves up with monetary inflation. Okay, pure and simple. Does gold move with high street inflation? Well, not always. No, it doesn't. You can get periods when inflation comes down and gold goes up and vice versa. But the high street is not monetary inflation, but monetary inflation is a component of high street inflation. You've got to think about what's happening to costs as well if you want to understand what the CPI is doing. Yeah. But ultimately, in the long term, monetary inflation is the driving factor of CPI. And what we're looking at is much higher inflation over the medium term. And I don't think there's any way of getting away from that.
You made me think here about in relationship with this recent gold move, $100, $150 up in the spot price. And what you were just saying made me think of this move's relationship to inflation expectations compared to the last move up on both of those accounts, including, in the summer and fall of 2020, gold had an incredible run to then new all-time highs. And I guess, hindsight's always 2020 here, but you could maybe make the argument that gold was seeing those inflationary pressures at the time, but that was when there was a little bit of concern about inflation, but we were told it was transitory. Well, fast forward to 2021 into 2022, obviously inflation hit almost double digits here in the US with the CPI report. You maybe wonder if gold was making that move in 2020, in kind of that insurance inflationary hedge move. And now this move here in the last couple of weeks, that relationship with inflation expectations midterm, I mean, I guess we're going to find out, right? Like, where inflation's going to be. It's always a lagging indicator. But, I just kind of curious if maybe gold's sniffing out the same thing a little bit earlier than people are anticipating. It just has gold
I think
has a
you're right.
mind of its own. Gold has a mind of its own a lot of times, right? And it's not.
Yeah, I think you're right. I mean, for example, we've done a lot of statistical work on looking at the relationship between different asset classes and liquidity. And one of the things that you find, I mean, this is small sample bias, so you've got to take it
Right.
as it is, but we haven't got a long history of Bitcoin. But Bitcoin tends to move about 6 weeks after a move in liquidity. Okay. The gold market moves about 6 months afterwards. And if you look at the
Mm,
recent history of both assets, that relationship seems to be pretty much intact. So the fact that Bitcoin has moved early and now gold is reinforcing that is actually what the data have been telling us. Now, I think the most important thing to say to get a perspective of this is to basically divide the factors that are influencing gold into two. One are the cyclical factors and the other are the trend factors. What drives the trend in gold is monetary inflation, in other words, liquidity, without any question. What moves the cycle in gold tends to be real interest rates. So if you look at how US tips are moving, what you can say is that the tips rate, in other words, the real interest rate, the Treasury the inflation protected security yield, tends to move opposite to the price of gold. So if you get an increase in the cost of carry, the gold price will come down in cost of carry in real terms.
mhm,
That relationship broke down in 22. Okay. And what was driving the gold price has been the monetary inflation, the trend factor. What investors have got to look at now is ask the question, why is it that the gold price is going up, but tips yields are telling you that gold is 20% overvalued? Okay. That differential is important because the market is telling us something that we need to know. And that need to know is what you've just highlighted is that, if you like, inflation, monetary inflation expectations are taking over. And that's the important point. The decoupling between real interest rates and gold is the most important thing I've seen in the last few months.
no, very fascinating. I want to ask you about the general commodities sector here. We are seeing a nice move in the likes of copper. It's moving above $4 a pound here this morning as we're talking early Wednesday morning, my time. We're also seeing a nice bounce in the oil price and energy price. So, that's obviously, we can speculate and have a conversation about that. But just kind of talk to me about this move, where we're at in this liquidity cycle and how it's having implications in the general commodity prices. It sounds like we're expecting growth.
Yeah, I mean, I think the fact is that when I said earlier on, this is a very normal investment cycle. The normal investment cycle basically says that you get a bottoming in global liquidity. Then around about 12, 15 months later, you'll see a bottoming in the world real economy, and everything seems to be pointing in that direction. So if you look at latest indicators coming out of the US, it looks like the economy is accelerating again. The CAS transportation index that came out in for February, came out a few days ago, was a lot stronger than people were expecting. And that's suggesting that there's definitely a bottom coming through into the transportation indexes. If you look at
Mm,
the month of January for LA Ports Authority said they had a record January, and that was a significant event. It's telling us that trade is picking up. The Chinese economy looks like it's getting traction. There's been a huge amount of liquidity thrown at China. Ultimately, that's going to come through. So it looks to us as if the world economy is beginning to turn around, and therefore you'd expect commodity prices to move higher. Now, the way that we view commodity prices, what our research does, is to split a commodity price into two moving parts. One is a currency of denomination, and let's think of that in terms of very simply the gold price in dollar terms, and let's think of the other factor as a real exchange ratio. For example, the copper price relative to the gold price. If you look at that real exchange ratio, the real exchange ratio, how much copper exchanged for a unit of gold, is determined by the tempo of the real economy. If the real economy picks up, the price of copper in real terms against gold will rise. Alongside that, you've got the gold price itself, which is responding to monetary inflation. So if you've got those two moving parts moving as one, what you're going to get now is commodity markets beginning to outperform the gold price. And that's what we'd expect. Gold moves first, then you get commodities about 3 months later.
Mhm.
And I think that's more or less moving on track now.
I mean, this is all very like I don't know if optimistic's the right word. Like, I mean, it sounds like there's a lot of wind to the sails right now, Mike. But it also, from where I sit, I also hear a lot of pessimism. A lot of people are just waiting for the hammer to drop, right? And for big
I,
recessions, like and maybe it's because we talk a lot with the the gold bugs quite a bit on the in this content, but it just seems like not everybody's buying this, right? I mean, do you sense the same thing that there's a little bit
yeah,
of
I think that's if that continues. I mean, that's an extremely reassuring sign. Um, So long may that continue. The thing that I'm more concerned about is that if you look in the near term, I think the market, talking here of Wall Street, has kind of got ahead of itself a bit in terms of the
Mm,
euphoria that has met the last few months' increase in liquidity. So I would fully expect that we're going to be vulnerable to some sort of pullback in that regard, particularly in the second quarter, particularly if we're correct about what you may see as a policy error by the Federal Reserve, a temporary one, albeit, but one that could happen. Now, the other factor that we've got to throw in here is the real economy. And if our expectations for, let's say, a moderate pickup are correct, things are fine. However, if you get an accelerating pickup, a much stronger economy, then all bets are off. And I think markets will have a bigger correction. And the fact is, the reality out here is that strong economies never have strong financial markets. And the reason for that is liquidity can only be used in the financial sector or in the real economy. If it's being used in the real economy, it is going to be sucked out of financial markets. And that's the
mhm.
danger, that you've got a too hot real economy. And that's what we're also looking at closely. It's good for commodity markets, for sure. And it's probably good ultimately for gold. But at the end of the day, the stock markets are vulnerable to that strength in the real economy.
Fascinating. Let's end it at that, Mike, because that's a lot of food for thought here. Appreciate your time. Thanks for doing
Great
this.
pleasure, Trevor.
Yeah, it's what a interesting time here. Maybe we'll follow up with you again in the next couple months as we uh, wind up, or excuse me, wind down Q2 and see how that played out. But I appreciate your time. Tell us where we can find you, Mike.
Yeah, well, the two best routes are, we've got a Substack which is called Capital Wars. That gives a lot of data and a lot of views of what's going on in liquidity terms. The other thing is we've got a Twitter site which is at Cross Border Cap, which is the handle. Or if you want institutional type research, look at our website, which is crossbordercapital.com.
All right, you can't go wrong with either of them. Okay, all right, everybody. We're going to take a quick break, and we'll be back with more here on Mining Stock Daily. All right, you're back here on our second segment here of this week's long form episode on Mining Stock Daily, and we're going to focus more on the metals, specifically in regards to projects' relationships with Western governments, including the U.S. government. We are happy to welcome in a new guest. His name is Todd Malan. He's the Chief Executive Affairs Officer at Talon Metals. And before he was there with Talon, he held a very important position as Vice President Corporate Relations at Rio Tinto. So, Todd, I'm extremely honored that you're with us here today. Thanks so much for doing this.
Yeah, thanks so much, Trevor. Glad to be here, and lots to talk about.
Yes, I don't think we can unpack everything in the next 30 to 40 minutes, but we're certainly going to try to cover as much ground as we can because, on the grand scheme of things, the relationship between governments of the West and industry has very much changed, but it still yet is a little bit unclear of what those relationships look like. We get stories here. We just got news this week of the Department of Energy loaning $2.25 billion to Lithium Americas in Nevada. We've talked about other projects getting some sort of subsidiary money from the U.S. government for those projects. I guess in your career, how has the last couple of years really transformed with this partnership between government and the mining industry?
it's a totally changed game. We're playing a totally different game now, and I think the drivers for that are a couple of different things. Number one is any nation, when it comes to national security, energy security, wants to have security of supply. It's no different than what the United States and Western countries went through in the 70s when oil prices spiked and people didn't have energy independence, and they learned the cost of not being energy independent. The Chinese learned that in the 80s when they needed iron ore and were really dependent on one source of iron ore from Australia, and were paying prices that they didn't like. And they decided to diversify their sources of iron ore and invest in Brazil and different shipping mechanisms to be able to address that security of supply. So right now, basically, you have the United States and Europe and Australia and Canada, Japan, South Korea, worried about the fact that they don't have the secure supply chains for the materials that are necessary for energy systems, defense platforms, basic manufacturing. And so I think those countries are gripped by that. I think that they learned a big lesson during COVID around security of supply, and that, oh, geez, when you need it and you can't get it and somebody else has the capability, that's a tough position to be in. And so I just think that is where we're at on security of supply, really motivating government policy right now. But it happened to come at the same time that we actually have a consensus that we have to do something on climate change, and that we have to decarbonize and move to cleaner energy systems, cleaner transport, and that clean energy transition is highly mineral intensive. So you have these two big drivers, global drivers, and then you also have geopolitical tension. So it's not enough that people feel insecure about security of supply for minerals that are required in manufacturing across a bunch of different really vital sectors. But there's geopolitical tension with many of the leading providers of those minerals, whether it's Russia or China. And so you've got these three things happening all at the same time, and it's really driving policy.
Yeah, well, and I think for us, intricately involved, I think our head spins quite often because we understand that obviously the geopolitics are heading into this direction. We talk about reshoring, nearshoring for the last, ever since COVID, and we I think we understand that and support this. But on the other hand, we also we we get really frustrated when we talk about things like permitting and this idea of like, well, of course, like we would like to find better better supply, but it's almost like we're unwilling to have that supply come from
Right.
the 50 states. And so how do you balance that out when you're having conversations not only
Right.
with people within industry but also the people in DC?
Right. It's kind of like, when I was a young kid and, running around crazy in the house, my mother saying, this is why we can't have nice things.
Right.
It's because, we've got this need, but we're confounded by some of the barriers to why we can't address them quickly. And on the other hand, I think the mining industry has to realize that this is kind of our moment. People really are waking up to the fact that they need what we provide. But on the other hand, we're dealing with our reputational challenges of a legacy of not performing in the way that society expects us to perform, and that they're very conscious of the damage that the mining industry has done in the past. and hasn't been around to clean things up. So it's this idea of how do you get it right? How do you find new ways of producing things that address what society is worried about? How do you live up to society's expectations of producing things responsibly, and also do it fast? And that's going to be hard, because we have this trust deficit. People are skeptical. We're finding that it's not just about mining. People are skeptical about, yeah, I want clean energy, but I don't really want to look at a transmission line or a solar farm or a wind farm. So it's not just in mining. There are things that our society is balking at, actually, the clean energy transition. So we have to try and find ways to do permitting that is rigorous, science-based, moves at a deliberate speed, but still involves public consultation and public engagement. That's not easy. And it really is going to take mining companies doing things differently, project developers doing things differently, off takers, the people that need our product, to also invest in the process and develop more of a partnership mentality. And it needs government to get out there and also explain to the public that these things are not are necessary. Oftentimes you see politicians sort of default to, oh gosh, can't we just recycle our way to these things? And, that's just magical thinking. The math doesn't add up. The scale of the ambition of what we want to do in terms of the clean energy transition requires lots more minerals. It's highly mineral intense. So we're at this really interesting place where, the minerals we want to take out of the ground in Minnesota or Michigan, are really a contribution to future generations' ability to have a circular economy, because those minerals are infinitely recyclable. But if we can't get them out of the ground, we won't have a circular economy. So, there's some really big issues here. And it's going to require a much more broad discussion with the public about it, if we want to do it right.
And it's not like you just started this. I mean, before you're with Talon, I mentioned your time with Rio Tinto, and you were based in DC then, it seems like, with Rio Tinto as a corporate relations. And even before that, you were with Goldman Sachs. And so you've got this incredible career the last, 20 years. And I'm just curious, like, has your responsibilities, or how you act on these responsibilities, gotten easier or more difficult?
I have to probably say, in some respects, easier, because there's never been more recognition. I mean, my area is external affairs, and that includes government relations, media, communities, relations with tribal sovereign governments. I don't think there's been a time in my career that the C-suite, boards, haven't recognized the value of what that kind of role and people that do my kind of work is to the company. There used to be a time where sort of that was a nice to have, or, you sort of got put off in the corner as the potted plant that did things that, were sort of necessary but unpleasant. I think now there's a strong recognition that this is inherent to the success of the business, that getting this right can add value to the bottom line. It's not overhead. So I think that's one thing about the kind of roles that I do now, or people on my team are involved in, is that there's a recognition that we're an added value part of the business. Then number two, I think that you see governments really recognizing that mining industry is essential. If you had told me that a Democrat would be in the White House and would have a roundtable discussion about the importance of critical minerals at the White House, When I first started at Rio Tinto, I would have thought you were crazy.
Hmm.
And so it really has shifted. Yes, permitting's still a problem, but I'm kind of tired of going to mining conferences and just listening to people whinge about permitting timelines. I think the industry also has to think about what can we be doing to improve our chances of a rapid permitting process. Some of that comes in project design. Some of that comes in listening to the community. What we've done at Talon Metals for our project in Minnesota is we did a lot of listening sessions with the community, and we took that on board and into our project planning process. And we made a radical decision. We moved the processing facility away from the mine site because one of the things that we heard from the community is that they were worried about long-term tailing storage in a
Mhm.
water-rich environment where the community really relies on hunting, fishing, wild rice in that community. And they were just very sensitive about long-term tailing storage. So we moved the tailings facility and the processing, 400 miles away to a drier environment in North Dakota. That costs money. It's a different way of doing things. Luckily, because we did that, I think we were successful in attracting $114 million of funding from the Department of Energy to help us build a processing facility in that way. But those are the kind of things that I think the industry has to say, we have agency too. It's not just about the improving the permitting process, and we can do that too. But I think
Yeah.
we have to take on some responsibility too of improving the pathway, de-risking the pathway.
Yeah, I remember when that news hit about the North Dakota Processing Center, and I was just like, "Oh my gosh, that seems like such a long ways away." I mean, that obviously brings up the cost of the project, and ultimately could be inflationary in itself, just for the processing of the metal. And anyway, but it made sense to me. Like, I get it, but
Yeah.
I do
Hey, you
think
know what? They don't make iron. They don't make steel in the Pilbara. They
right,
ship iron ore all around the world to smelters, and they move rocks. So
yeah.
it's not that crazy an idea.
Right, right. But I do think for such a long time, the relationship between between industry and government has been left or right, black and white, yes or no. And we're starting to see those lines maybe get, that those divides get expanded into, we can have an actual can we have an actual dialogue about, it's not a no, but it's a potential, we got to improve in certain areas here. Whether it be the infrastructure, the process of the actual operation, or even the relationship with the local communities, what that looks like. And I understand if you're going to not necessarily expedite, but improve the process for mine development in the United States, it's got to it's it's got to be methodical. It can't be just slow as snot. It's got to be faster than what it has been, but it's got to be methodical, and you want to do it right because you're only going to have one shot at it.
Right.
um and I guess I don't think this is a question or anything. I just think I think it is improving a little bit, but it's just not improving fast enough for industry.
That's right. But that's a healthy tension, and I think we
Sure.
can continue to raise that it's not fast enough. Um, I think the environmental community actually has to confront their role in this as well,
Hmm.
and think about ways that they want a fast, clean energy transition. They want to decarbonize industrial policies. Um, they can sit on the sidelines and protest and uh, complain, or they can roll up their sleeves and be part of the process. I look at in Montana the Sibian Stillwater Good Neighbor Agreement, in which local environment NGOs participate in an independent water monitoring process that gives the community confidence that they're not just taking the company's word for it that they're protecting the water, but they've got a means of independent validation.
Yeah.
And I think those are really great examples where civil society is joining with the private sector, joining with government in order to produce the things we need at responsible levels and at a high level of trust. I think what Canada is doing in terms of tribal nation participation, First Nations participation in projects to contribute tribal knowledge in the project development, to ensure that things are done right during the operation, and to ensure that closure is done right, and that tribes actually get a piece of the pie of the economic benefits, is leading the world. I don't think anybody's doing it better. And I think that that's where this sort of Goldilocks outcome is going to come, is when NGOs put down the protest signs and meet with project developers. Project developers have an open mind about how they can do things differently, and communities express what they need to have things done right. That's where the solutions are going to come.
I want to ask you about the money coming from Washington, D.C. to specific projects. Obviously, Talon, you mentioned that it was $114 million that was announced back earlier this winter. That was a healthy chunk of cash. We had $2.25 billion loaned to Lithium Americas in Nevada. That was just announced this morning as we talk. That's a huge deal. Perpetua Resources, they have Department of Defense money coming into Idaho. So we have these different entities of the U.S. government having some sort of say in projects with the action of the U.S. dollar and where it's allocated to. Share with us kind of like which bureau or whatever is going to have the most pull to say when it comes to getting some of these permits up and going and projects approved. Is it going to be energy? Is it going to be defense? I mean, who has the best pull here?
Well, I mean, right now, certainly the IRA and the bipartisan infrastructure law primarily work through the Department of Energy as the entity that makes competitive decisions about different projects to get behind. And one thing that's important is, yes, we got selected for a $114 million grant, but it's not like they just write you a check and here's your $114 million. You negotiate a contract, you have to earn your way into that. And part of that is to earn the permit. So you get selected, and I don't care whether it's a solar project or a wind project or a hydrogen project or a mineral processing project. You all have to go out and earn your permits, and then they fund at different stage gates as you progress towards operations. So just to be clear about that, but and I think that's appropriate because these are taxpayer dollars. These are not loans. These are grants. So they absolutely have to protect the taxpayer in that process. But I do think that when the government makes an investment, we also got $20 million worth of funding from the Department of Defense for our exploration program in Minnesota and in Michigan. That basically doubled our budget for exploration. And the idea is that there's more nickel, more high grade nickel in America. And I think that has been incredibly helpful to us in terms of just credentializing the idea that somebody independent in the government has decided that nickel is an important ingredient for clean energy systems and defense platforms. I mean, if you think about a nuclear submarine that the United States is building for itself or building for allies like Australia, requires millions of tons of very high quality steel. It's called HY80 is the grade of steel. The alloy material is nickel. If we're dependent on China or Russia for our nickel, and that nickel is required in nuclear submarines, it's probably not a very safe place to be, especially because we've seen China leverage its leadership in pertinent areas and withhold access to gallium, germanium, now graphite. So you don't want to be in a position where you can't get the ingredients to build your nuclear sub or other defense platforms. And that's why they're doing this. But when the Department of Defense gives out money, I think the community sits up and pays attention because people do care about national security. That's a credibility thing that is quite helpful as projects move through the process. It causes people to sit up in their chair and say, okay, I want to know about this. I want to understand more about why do we need nickel or why do we need lithium or gallium or any of these things in the elemental table that are on the critical minerals list.
Yeah. Todd, Russian nickel and aluminum were left off the latest sanctions against Russia. And we can talk, just interesting. I'd assume they were left off because the volatility that would ensue following something like that would be really tough to overcome quickly. Is that safe to say?
It is. I think, I was on the Rio Tinto aluminum senior leadership team or executive committee for about 5 years. And it was during the time when President Trump put Section 232 tariffs on aluminum, including aluminum on Canada for a brief period of time, which caused tremendous market disruptions that were expensive for U.S. manufacturers. And also when Rusal was sanctioned for aluminum, and that caused some price shocks for the aluminum system. I think that caused the Treasury to be pretty cautious about sometimes taking that sanction in the commodity sector. Because it caused problems for supply chains in Europe and other places. My personal opinion is they're now a little too cautious, and I think that if you want to encourage secure supply chains in the United States or Canada or Australia, and you have malign actors like Russia that produce those materials, yes, it may be a little bit disruptive, but I'd prefer them to take those actions when they have a triggering event that causes them to use sanctions. They should probably use them in these areas because that would then help the secure supply chains in these areas. If you just look at Australia right now, we've seen curtailments in nickel supply at exactly the time that the IRA was supposed to favor Australian and Canadian nickel. So it's ironic that we're seeing this favored position for Australian nickel, but the Chinese operations in China or in Indonesia that are flooding global markets and driving down prices are actually having the effect of undermining the economics of Western nickel providers at exactly the time that the IRA was supposed to favor them. I don't think it's incidental. I don't think it's happenstance. I think it's intentional.
You think this is kind of Cold War-esque political positioning?
I think it's protecting an advantage. I think it's rational behavior. But the time of the Chinese talking about win-win outcomes is long past. That was 20 years ago. I went to an event at the Australian embassy last night, and the Australian ambassador was talking about this, and he made a very funny but apt comment. Xi Jinping is not reading Adam Smith. The talk about the benefits of free trade in essential materials is probably a little old right now.
Oh, fascinating. So let's bust open this story on nickel. We've spent a lot of time talking to a number of different people about the nickel market the last
Yeah.
couple of weeks, and we've had a lot of insights on the global trade and what's coming out of Indonesia, the oversupply. Last week we had a conversation with mutual friend Martin Turen from FPX regarding Macquarie Bank analysts coming from China with a silver lining, saying perhaps maybe this oversupply we thought was coming on is overdone. Um, and so I guess we'll take any silver lining we can get when things are really bad. We'll find optimism at every corner. But
Sure.
give us, it's funny because there is politics, there's geopolitics involved, there's free trade agreements involved, there's a massive supplier of nickel coming out of Indonesia, and we can have a conversation regarding the environmental standards of that production and what it
Yep.
means for Western governments. It is quite, I guess, frankly, it's a mess. It's quite the mess right now. But does it feel like we're starting to get a better understanding of what the future of the nickel market's going to hold for us in the next few years?
Well, it's the old saying in Washington: "Don't let a crisis go to waste."
Exactly. Right.
And I think that's what we're seeing right now. Is this crisis has caused governments to sit up and say, "Hold on a second, what's happening here? Why is it happening? And what can we do about it?" And so you had Australian Natural Resources Minister Madeline King in Washington last week, meeting with the Department of Defense, meeting with the National Security Council, meeting with the Department of State, meeting with the U.S. Trade Representative. Minister Wilkinson was just at PDAC and talking about these same themes. So I think government leaders are gripped by the situation and the crisis. And are going to do something about it. I think they've got a number of tools at their disposal, and I think we're going to start to see some action on that. I think the IRA, as it came from Congress, really had two goals. One was to build up security of supply, and the other was to get clean energy systems to scale, and try and get EV adoption in particular to scale, or solar or wind to scale. You can see those things as in competition, or you can see them as something that has to be done at the same time. I think the Biden administration is figuring out how to get those things balanced correctly. But, if you don't get that balance correct, then there's going to be people that will abuse the system and try to get around rules like the foreign entity of concern and engage in things which I call mineral laundering, where people are taking minerals produced at low standards from ineligible countries and then trying to sort of launder it in free trade countries like Korea or Morocco. Hopefully there will be strong enforcement mechanisms that will prevent that, or those enforcement mechanisms will create reputational damage for people that engage in those practices. So OEMs or battery makers that decide to go with cheaper products that have to rely on these schemes or mineral laundering schemes, and then they get caught in an audit and they've got egg on their face because somebody found that they've got Xinjiang lithium or Xinjiang produced nickel in their battery, and they lose their ability to actually produce in the whole IRA credit system. That reputational risk is real. So I do think that people are going to have to really think about what are their values as a company. And, you can put all your ESG values on your website, but if you do something different in your behaviors and you're buying Indonesian nickel produced by Chinese companies and trying to do an end run around the FEOC rules, you may pay a price for that with your consumers or with the U.S. government. And some of that we're seeing right now. The easier thing to do is to pay a little bit more and work with suppliers in the U.S. or Canada or Australia to have improvements and drive down prices. I was really heartened by Panasonic's investment in Novo Mond recently, for offtake for graphite from Canada, produced at a high standard. That's the right pathway. We are very fortunate to have a partnership agreement with Tesla, and I use that term very deliberately, and Tesla lets us use that. We have a partnership with them. We talk to them all the time. They're not just, hey, produce nickel by 2027 and that's it. They're helping us in the permitting process. They're helping us to think about innovations in the processing of our product. And it's a real partnership. And that, to me, is the right way to do things. And it's going to take that kind of solution to do it. But, we do have to think about how we compete. And I do think that the other place that a lot of money is being put into is in innovation. And we have a partnership with the Argonne National Lab to come up with innovative ways to produce more from the same ton of rock, to make sure we're not sending valuable materials into waste piles. That is also going to be helpful in our competitive ability to compete against Chinese supply. If we can get more batteries from the same ton of rock, then we're using innovation to compete.
Right. You did mention a key word in that answer, and that's processing. I mean, we talk a lot about mining, but I don't think enough time is spent on the processing, the refining of these metals. And as much as everybody else listening to this podcast, a lot of product that is mined and formed into a concentrate here in the United States typically is refined overseas. In fact, you could if you take Apple products alone, you take a list of their complete metals refinement list, it's about 70-80% of it is all refined in China. So we talk about, once people kind of start figuring out where their metals come from in these products, will they, force change? Well, we could start with the iPhone for sure. But there's a great opportunity here. And, you could talk about the Rust Belt. You could talk about the Mississippi River valleys, Missouri River valleys, about excellent places to really enhance processing and refinement facilities and have ability to ship those products directly from those centers into the global supply chain. Is there conversation in Washington about not just mining, but expanding the processing infrastructure for U.S. metals into the global space as well?
Yes. And it's really exciting. I mean, the money that we got from the Department of Energy, which came out of the bipartisan infrastructure law, is from a $6 billion envelope of funding for critical minerals processing, battery processing. So that's a lot of money to be, and that's got to happen in the United States. And that's all for increasing the muscle in the processing of critical minerals. So I think there's a lot of money there. Then in the IRA, you have Section 45X. And I know for a lot of folks, sometimes it's sort of the alphabet soup of the IRA, and it's hard to keep track of all these different programs and incentives. But this is the real game changer in this area. Is 45X has an application in critical minerals. And what it says is that for taxpayers that process critical minerals, and there's a list in the law of 50 different elements, and process to a certain level of quality, so 99.1% pure or different types of formulations, but it's spelled out in the law. But the reward is something remarkable. You get 10% of your production cost back in a tax credit. And so it applies to lithium, it applies to nickel, it applies to, rare earths, platinum group metals. It's a whole bunch of things. But if you think about project economics and you think the government's going to pay you back 10% of your production cost every year, it really helps a project to pencil out over time. And the guidelines are being finalized, and there's some real nuance that has to be worked out there. But if you just take Tesla's lithium hydroxide plant that they decided to build in Corpus Christi, Texas, that to me is exactly what this is meant to incentivize, is to say, come to America, build the processing to create the essential materials at a high standard in the United States. That's what 45X is for. And I think it's really going to be a game changer because it's also the only provision in the IRA that doesn't sunset over time. So Congress will have to proactively go into the tax code and end it, as opposed to the other parts of the 45X for wind or solar manufacturing or battery manufacturing that trail off in 2028 or 2035 or 2032. They all have different rules. Critical minerals was the only one that didn't have an end date. So it could be a really big game changer in processing when you add in that there's also this grant money from the bipartisan infrastructure law, $6.3 billion.
Wow. Todd, I don't want to take up too much more of your time, but I do have kind of a general question about, the status, the health of the conversation happening on Capitol Hill regarding this. I mean, I live in Colorado, obviously very purple state, turning a little bit more blue every election cycle, it seems like. But for most of America, it seems like we're, a lot of Washington just talks at each other rather than with each other. And a lot of those individuals that have served in office for many years that have, I guess, if you may say, have a pretty level head on their shoulders and know how to get things done and have a more interest of what industry looks like outside of Washington, we're losing those people. And I think of Senator Manchin right off the top of my head, who understood what supply chains actually look like, what energy looks like. And you can't go from point A to point B in 2 steps. It usually takes about 30 steps. And those people seem to fewer and fewer almost every year. So how do we have those conversations again to learn from each other?
That's true, but I actually feel that in critical minerals policy, it's one of the few places where there's real consistent bipartisan support. And yes, it's going to be a huge loss not to have Senator Manchin in the Senate, but there's other people that are also equally gripped and equally interested in this area. And it's not always where you think it would be. It's not always the people that are in mining states. There's actually quite a few people that have done their homework and are interested in this area. And I think trade policy and critical minerals policy is an area where there's been an enormous read across between the Trump administration and the Biden administration, kind of ironically. Yeah. So you asked earlier about in my career, is it a remarkable difference? And I think this is what makes this part of being in critical minerals policy actually kind of fun, because it's an island of outside the culture wars. It's an island of bipartisan agreement in the main, where you actually have people that are willing to engage in this area because they are worried about how are we going to build the stuff that we need in the clean energy transition? How are we going to have national security systems that we can rely on? And I think we see a lot more people willing to come on mine tours and get out and see things and engage in the conversation. So I'm actually quite hopeful on that. I do think politically, I get asked all the time, what do you think a future Trump administration would look like in terms of the IRA and things like that? And I think the President Trump has been very clear that he's not a big fan of tax subsidies for EVs. I don't think he's hostile to electric vehicles. I don't think he's going to rip out the IRA root and branch. I do think that he will likely focus on the Chinese oversupply in a way that will be perhaps more aggressive than the Biden administration He's certainly not going to do a free trade agreement with Indonesia. I don't think he'd do a free trade agreement with Scotland, even though his mother was born there. I think he's not a big fan of free trade agreements in the first place, but certainly not going to do a free trade agreement that would benefit China. So, I think there's actually a lot of bipartisan agreement, and I'm quite hopeful about the future that will only continue.
Okay. All right. Todd, this was a great conversation. Thanks so much for your time.
Yeah, a lot of fun, Trevor. Anytime, and feel free to check back in with me. I'm great to be a fan of the show, and happy to be on.
Yeah, thank you so much. I do think come November, that'll probably be an appropriate time for us to chat again. Maybe we can just stick our heads in the sand and still have the conversation, something like that. Yeah. But I'll just, at least I can always go, climb a mountain and get off grid, but you got to live in that city, which.
True. Yeah. I try and get out of the city every once in a while. So
I would get out as quickly as possible every weekend, I think, if I was living there. Thanks, Todd. All right, everybody, that's a wrap here on Mining Stock Daily for the week. Have a wonderful weekend, and we'll be back next week with the morning briefing. Well.